This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Hello, fellow investors. Welcome to another episode of Value Investing. I just started this podcast with a quote from Warren Buffett, and this is a very important concept, and also it's going to be related to the topic that we are about to talk about in this episode. In the last episode, we talked about economic mode, and that is a very important concept if you are trying to understand Warren Buffett's investment philosophy. So if Warren Buffett wants to make an investment, he looks at the following criteria. Number one, he wants to buy a business that is simple enough for him to understand the business model. So this is also known as a circle of confidence. Second, he looks at the business with durable competitive advantage, which is also known as economic moat that we discussed last time. Third, he wants the business with able and honest management team. And lastly, he wants to buy business that is selling at a fair price. So this is also known as margin of safety. Since we talked about economic moat, which is one of the important components of his investment philosophy, I decided to talk about margin of safety in this episode. This is a very important concept for you to understand if you're trying to get a grasp of how Warren Buffett invests his money for the long term. So I'm so excited to talk about this topic. I think there are just a couple of things that I want to talk related to margin of safety, and let's just go over them. But before we do that, I just want to give you a quick disclaimer, as always, that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? As I mentioned in the intro, our topic today on the show is margin of safety. So why don't we define what it means so that everyone is on the same page in terms of margin of safety concept. So margin of safety arises when there's a difference between intrinsic value of the company and the market price. The larger the difference, the larger the margin of safety. So let me just give you a quick example just to facilitate your understanding. If you're trying to buy a bag, maybe from department store, and you know that this bag is worth $100 all the time, and you know that if you buy this bag by paying $100, you know that you can resell this bag to other people for exactly the same amount. Let's just assume that for the sake of simplicity. And one day, whatever the reason, the department store goes on sale for a lot of their items, including this bag. And this bag is on sale and you can get discount and you can buy now at $60. So you know that there's a difference between the intrinsic value, which is $100, and the current market price, which is $60. So there's $40 gap and you buy this bag. Because you know for sure, after the sale ends, you can even resell this bag to other people for $100. So that's kind of the concept of margin of safety. You can apply exactly the same logic when it comes to buying a stock. Because for every stock, there is a company behind. So if you know how to assess the company's intrinsic value, and if you follow stock market and the market price of the company, if that stock price is significantly below the intrinsic value, then that means you have high margin of safety. So that's the definition of margin of safety, and it sounds very simple, but let me tell you right up front that this is not easy concept to implement when you are making your investment. So what I like to do for this episode is to talk about why it is so hard for an average investor to implement this strategy when it comes to buying stocks in the stock market. Actually, before we do that, why don't we go through several approaches to calculate and to assess intrinsic value of the company? Because in order to calculate margin of safety, you have to know two things. Number one, you have to know the stock price, which can be easily obtained by just going online and check the stock price. And you have to know the intrinsic value of that company. So you need to know how to calculate intrinsic value. I've already covered these topics in the past episodes, so I'm not going to go into the details of each approach. But what I like to do is I like to just go over each of the approach quickly so that we can refresh our memory. First approach is called discounted cash flow analysis. And this approach requires a lot of assumptions for your calculation. For example, you have to know how much cash flow this company is going to generate, let's say in the next 5 years or 10 years. And once you forecast these cash flows, you have to discount these cash flow back to present value. For that calculation, you need to come up with discount rate appropriate for discounting future cash flow back to present value. So there are just a lot of assumptions you have to make, but theoretically, this is probably the best method you can use for intrinsic value calculation. The second approach is called ratio approach, which is quite simple. You don't maybe have to do any calculation if you want to use just trailing value of the company. So for example, if you want to calculate price to earnings ratio, you can simply use the current market value of the company, and for the denominator, you're using trailing 12-month earnings. Then you don't actually have to do anything, but you can just go to any stock website and you'll easily find this metric. By the same token, you can get easily price to book ratio, price to cash flow ratio. And in some cases, for the denominator, instead of using trailing 12-month metric, you can use 1 year forward-looking forecast. For example, if you want to calculate price to earnings ratio by using 1 year forward-looking earnings, you can just do that, and a lot of these numbers are available easily on any stock-related websites. So there are pros and cons between discounted cash flow analysis and ratio-based approach. The third approach you can use is simply comparing the market capitalization against the book value on the balance sheet. So this approach is also very simple because you can get this book value number directly from the balance sheet easily. You might have to make some adjustments in order to come to better book value number, but it's very simple. The last one is a little bit tricky because this is acquisition approach where you're trying to assess intrinsic value of the company by predicting how much other competitors are willing to pay for the business that you're interested in buying. Because if other competitors are interested in buying or large companies are interested in buying this company, they usually have to pay high premium on top of the stock price. And usually this valuation is therefore higher than using other approach. So these are the four main approaches when it comes to assessing intrinsic value of a company. So these are the technical details you might have to study by yourself and understand fully what are the pros and cons of each approach. But what I like to do for this episode, on today's show, I like to talk about why it is so hard to implement margin of safety concept, even if you derive the right intrinsic value. So let's just go over them and see how you can cope with these kind of difficulties. So first difficulty or hurdle that you're going to face when it comes to applying margin of safety is the fact that all these intrinsic value calculations are very prone to what assumptions you're making. So for example, I mentioned that if you calculate intrinsic value based on discounted cash flow analysis, The final intrinsic value number is going to vary quite significantly depending on which assumptions you are using. For example, if you're using, let's say, 10% discount rate versus 12% discount rate, even though it sounds very similar, only 2% difference, but it's going to make a huge difference in the final number. Also, depending on how you want to forecast future cash flows of that company, your final number is going to be different. And if you use a terminal value approach, which is very common for discounted cash flow analysis, you always have to come up with some terminal value, and that one is also very subjective. Second hurdle that I want to mention is that margin of safety concept is very subjective concept. What I mean by that is, let's say you have no intrinsic value of that company. Then how much margin do you want to apply when it comes to buying that company? Do you want to have 10% margin or 20% margin, 30% margin, or even more? Because let's say the stock's intrinsic value is $100 and stock price fell below, let's say, $80. So you have approximately 20% margin. Then is it the right time to buy the stock? Or do you want bigger margin, maybe 40% or 50%, and you just wait until you secure the margin? So this is kind of the question that you have to ask yourself when you're buying a company from the stock market. Because the company's stock price may not go below the threshold that you set, and you may not be able to buy the company at all in the future. So there's a risk of missing out on buying that company versus there's a risk of stock price falling below whatever price you're paying. So you have to determine what is the right margin for your investment. Third reason why it is hard to implement margin of safety concept is because it requires significant amount of patience from you. Because you have to wait until the stock price falls below whatever margin you set. And sometimes it doesn't happen for 5 years, maybe 6 years, or it may never happen at all. So it requires significant patience. So that's why I'm saying it is not easy to implement. So we just talked about 3 reasons why it is not easy to implement this margin of safety concept in a daily investment situation. So let's quickly go over them. First, intrinsic value calculation is going to vary depending on which assumptions you're using for your intrinsic value calculation. Second, this margin of safety concept is very subjective, and people may have different threshold for whatever margin that they want, 10%, 20%, and so on. Third, it requires significant amount of patience because you have to wait until the stock price falls below your threshold. Now, what I want to do is, what can we do given all these difficulties when it comes to implementing margin of safety? The first thing that we can do is, when you calculate intrinsic value, instead of just deriving the intrinsic value number to a single number, what Warren Buffett recommends for the most part is just come up with a range. So let's say your intrinsic value range is $10 to $20 for a certain stock. And if the current market value falls between this range, then maybe you don't want to buy the stock because you're not securing big enough margin for your safety. But if the stock price falls below $10, which is your minimum intrinsic value calculation, maybe you can secure enough margin for your safety and you can buy that stock at that point. The second thing you can do is just pass on whatever stock that you have investigated if you're not sure about that investment. So if you're not sure about what this business is doing and what the business model is, then you can just pass on that investment. If you're not sure how to calculate intrinsic value of the company, you can pass on that investment. If you're not sure that this company is selling below intrinsic value, then you can pass on that investment. If you're not sure that you don't have enough margin of safety, you can pass on that investment. You can just wait and wait and wait until you finally get to the point where all these criteria had checkbox checked. The third thing that we can do is create a watch list, because that's what I do for my investment portfolio. What I do is I put all these stocks that I'm interested in my portfolio watch list. And what I do is I just don't do anything until something really bad happened to these companies. And usually there's a scandal that's going to drag down the stock price of certain company. And I look at the situation and try to assess if it really warrants the stock price drop. That happens all the time, even for really great companies. So if that type of scandal happens, what I do is I make the assessment, and if the current assessment shows that stock price drop is not warranted under that circumstance, then I buy the company when I believe that the current stock price is below intrinsic value significantly. Fourth thing that you can do is don't check stock price all the time, because if you are checking stock price all the time and every day, then you're going to be influenced by Mr. Market, which is another concept we discussed in the previous episode. So don't check the stock price all the time every day, because you're going to be influenced by them in a negative manner. So what you can do in order to improve your patience and temperament is just you make yourself occupied with something else. Maybe do more research on other stocks, or do other activities, because that's going to be a lot healthier for your mental health. And also it's going to be good for your portfolio management, because then you're going to allow yourself to develop the patience that is required to be a successful investor. Because as I mentioned, if you want to implement the margin of safety concept successfully, you need a lot of patience. And you cannot be really patient if you're watching stock market every single day and you get distracted by all this media news and articles. So I think those are the things that what we can do in order to implement margin of safety, but it's always easier said than done. And a lot of people know in their head that what they have to do, but when they lose money, significant amount of money, or even gaining, some profits, they just act irrationally, and that's not really healthy for their portfolio returns. So let's just keep that in mind. I personally think that knowledge is very important, but what's equally important is the temperament and discipline. Even if you don't have the right temperament for the stock market, there's a way you can develop your mental muscle. And that's what I like to do through this kind of podcasting, because as you listen to the same thing over and over again, you probably will be able to develop the muscles that are required and that are necessary for you to become successful in the stock market. And I'm telling you all the time that you need to do the long-term investing. You have to develop patience. And that's what Warren Buffett and all the other legendary value investors have been telling other people. But what's quite interesting and funny is that people don't listen to these legendary value investors. I don't know why, but that's what happened to a lot of people. And that's just the nature of human being. So if you develop this kind of temperament and muscles, mental muscles, in order to prevent yourself from doing stupid things when market crashes or when market goes up significantly, then you're going to be way ahead of other people, because other people get super fearful and they either sell their stocks when, stock goes down. I mean, I'm not saying that you should not sell the stocks at all, but you have to make the assessment in an objective manner, not based on your emotions. So that's going to be a huge advantage for you and give you upper hand in many situations. So let's just take a look at what Warren Buffett has done so far. Because if you look at 50s or 60s, Warren Buffett purchased companies when they are selling at very, very low price. At one point, Warren Buffett was able to accumulate 20% of his portfolio by purchasing stocks of Dempster Mill. So this is the company that has been in decline for quite some time, but Warren Buffett purchased this company probably 25% of the book value of the company. So this is quite excellent price that Warren Buffett paid. However, this company was obvious to deteriorate over time. But Warren Buffett was able to recoup whatever investment that he made, and also he got a decent return from this company. But this is kind of the cigar butt approach that he adapted at the beginning of his investment career. But later on, Warren Buffett switched his approach, and now, as I mentioned at the beginning of this podcast episode, he's saying that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So he's arguing now that you have to pay maybe a little bit more for a wonderful company, and over time, I'm saying like maybe more than 10 years, it's gonna bring you a lot more returns. And Charlie Munger once said that you just have to be smart once if you implement this approach. But if you're trying to implement cigar butt approach, then you have to be smart all the time, because once you buy the company very, very at cheap price, then you sell the company and you get the return, but you have to find another company like that over and over again in order to increase your portfolio value. However, if you buy wonderful companies, then you don't have to do anything. You just let it run by itself, and it's going to generate tons of money for your portfolio. So that's what I wanted to mention related to Warren Buffett. Okay, so I think we talked about a lot of things with respect to margin of safety. I hope that this episode was helpful for you. As I mentioned at the beginning of this episode, I was able to complete the development of the website for this podcast. So whichever platform you listen to this podcast, you can just pay a visit to that website and let me know if you have any comments related to the website that we have for this podcast. Thank you for listening and see you next time.